Ladies and gentlemen, as you may be aware, I achieved my financial goals in the first 6 months of this year, taking my $130,000 dividend stock portfolio and turning it into $170,000. I'm going to be breaking down the capital contributions along with the capital gains and my dividend yield of 4.4%, which the yield on cost is actually closer to 7 or 8%. And I really believe you can get a high yield and high growth and achieve some of these results of getting about a 15 to 20% return a year. Now, before we jump into the analysis of this, I think it's important to give you guys some personal updates, as I currently have some family members going through some unfortunate health issues, and it is a fine reminder while I sit here on my ass playing around with websites, YouTube, the stock market, that I need to get up and you need to invest into your own health. So I went ahead and did a massive run this morning, and I recommend that you all invest into your health so when you get to your financial independence, you can actually have the ability to enjoy it too. And finally, guys, as you may be aware, I purchased a website domain called SPACstock.com for $1,000, and I've been getting mixed reactions about this because I'm not a fan of SPAC stocks. I'm not here to really promote SPAC stocks, but I'm breaking down a lot of the information into an SEO, really optimized website, doing a bunch of backlinking and complicated things that glaze most of people's eyes over, just like the stock market does. But to give you an example of what I've been able to achieve so far, this is the sponsor for today's video, as it always is, but we're talking about the chartmaster.com. It's a portfolio spreadsheet tracker that I think is one of the greatest that currently exist on the market. And I've been able to get ranking for this that's achieved 9.2K impressions over the last 3 months with 213 clicks, actually leading to sales. And I'm going to be giving you guys a full launch update when I take the website live, probably around Tuesday or Wednesday. It just takes a stupid amount of hours to get the SEO properly finalized, but don't worry, I'll be getting there, folks, to show you guys what I'm actually working on. And I'm not going to drill my sponsor down your throat. The links are always in the description below. But ladies, gentlemen, I look so forward to breaking this down for you. So let's jump. Welcome back, my passive income investors. Some pretty exciting news, but if we went back to March, this would have been a whole different story here, folks. But I want to break down how I'm able to achieve such a high growth rate and a dividend yield. And it comes from this diversification of 40% growth and the 60% being really high dividend yield paying stocks. As many of you might be aware, the only sectors I have exposure to are fairly high yielding sectors, because obviously we're talking about utilities. I mean, we've got our financials, our REITs, and our healthcare sector in there. I mean, that was always the initial intention, was to get at least a 4% yield and some decent growth stocks backing the whole thing up. I just didn't realize how well this structure was going to work, because many of you are aware most dividend stocks are not doing well right now, which we're going to see once we get into the individual accounts. But the reason that this does so well is the 40% growth drastically makes up for the lackluster performance of, say, financials or REITs. But I'm pretty confident in a year or two, I'm going to see some more capital growth on that side, the dividend side of the portfolio, which should take me into the atmosphere, folks. I'm hoping to get to my goal of around 200,000 to $250,000 in the next couple years here. But nonetheless, let's talk about the 6-month capital gains along with the 6-month contributions. Keep in mind, as of recent, in the last 3 weeks, I've had a huge amount of growth that is not calculated into this. But when I last updated you guys, I told you that in the 6-month end, I had about $15,631 in capital gains and dividends included into the growth, along with my own contributions equated to about $8,300. Today, it'd probably be closer to $9,000, and the 6-month capital gain, if we include July, would probably be closer to $20,000 to $25,000, if I'm being honest. And this is some pretty staggering stuff for me to even grasp right now, as I've worked for 5 years to get to this point. But let's talk about the dividend yield real quick, as I'm bringing in about $583 a month. That's pretty stupid. That's already well above my goal for this year. But nonetheless, how does this 4.4% yield become 7 or 8%? Well, you have to understand that this yield was calculated in, I think, at the beginning of the year with what my current dividends were against my portfolio value. But my portfolio has doubled in the last 5 years, folks. So let's get into some of the individual accounts and first again talk about the performance. So what this represents is each one of my accounts when I started it. As I tell you guys in the past there, that the orange line is my longest standing account. It's just a regular managed account. My tax-free savings account that I started back in July of 2017 is the blue line. And then finally we have my RRSP, which makes up the black line, which is the newest account, which is just stupid because I've over doubled it in less than a year, primarily thanks to Tesla, Facebook, some other good growth companies sitting in there, which we're going to get into here, folks. But you have to understand that I don't know how to calculate my dividends right now other than basically minusing out my portfolio by half, because if I take the averages, because my RRSP is up 121%, my cash managed account is up 88%, and my TFSA is up 87%. If we take the general median, it's around 97 to 98%. It's probably a little more than that if I just completely tap my RRSP into the percentage weightings, if that makes any sense, of course. Nonetheless, folks, we are teetering on 100% return over the last 5 years. Stupid. That's stupid kind of returns here, folks. But I really love showing you what is capable. And I just want you to understand, I have made less than $40,000 a year. I make a regular income just like anybody else. Anybody has the capability of achieving these exact same results. Now, getting into the individual accounts, in and of themselves, guys, the TFSA, I'm getting some real fat dividends coming in this month. I mean, I'm talking about, I think converted to CAD is about 700 or 800 in dividends, which I'm going to be using to purchase some more RioCan. And I'm also going to diversify a little bit more of it into some MindMed as well. But other than that, all the driving growth, as you can see, comes from Apple and Microsoft. I really only hold 4 real tech stocks, guys. And even though they make up 40% of the portfolio, it's just really nice to see, you know, all this red. You're like, oh my God, look at all the red in his portfolio. I'm down, you know, 40% on GEO Group, which, by the way, I'm never selling. I love that company still, and I can't wait for the earnings to come out to see if that opinion ever changes in the near future. But nonetheless, guys, with all this red, these few growth stocks just slaughter the performance in these accounts. And it's something mind-blowing. You can really only contribute, I think, about 60-something thousand, maybe close to 70,000 to your TFSA. And I have grown this account to 106K since I launched this account in 2017. Now, taking a look at some of the other accounts, the managed account, my longest standing account, which you guys may recall when I got into stock market investing for the first year and 6 months, my portfolio dipped almost 50% here, folks. So, I mean, I've had a lot of experience trying to figure out what gets me to the current performance that I'm having here. And going back into that managed account here, I moved stocks around so much because this is like a holding account for me, whereas going into next year, I'll have room to contribute to my tax advantaged accounts. And that's what I do with my managed account. I'll hold some good growth companies like Facebook. You know, I like a little bit of dividends with RioCan. And then what I'll do is at the end of the year, I'll pull that money out and shift it into one of these better accounts, obviously lowering and changing the percentage weightings, which really fluctuate in the performance of this account. But Facebook has been absolutely on a tear in this account, and this RioCan position has come down a little bit, and which is why I'm going to be doing my final tranche purchase in my tax advantaged account. Now, I have been lying a little bit to you guys because even though $170,000 is my financial goal for the year, you have to keep in mind $5,000 of that is actually credit. So if I actually paid that back and liquidated the shares, I would really only be at $165,000. But I figured I don't really tack on the website value or my car or my other assets. So I know for a fact, like, I'm well above that 170K mark. But just talking about the portfolio in and of itself, guys, I mean, I've been using the dividends off these positions to pay back the line of credit, which gives me tax advantages. And as soon as they hit that line of credit, I actually end up owning more RioCan shares over time. So I'm glad that it's back down below 15. So I'm hoping it stays here at least for another week or two, so I can get some more dividend income to pick up those final tranches of shares. And then I'm going to move on with my life from RioCan. Obviously, always updating you guys here on the channel. Now, the most explosive account, as I've talked to you guys about a lot, I am up $35,000. This account started at $14,000, guys. Not even 6 months. Well, I guess it would be about 8 months ago now, going back to November of last year. And we can see that all of the driving growth comes from Tesla right now. I'm up 333%. Facebook's up 16% in this account. Johnson & Johnson's up, still spitting out dividends. I got some decent money sitting in this account. And it's just crazy to me when you have all these different accounts spitting out cash, guys. It's such a good feeling at the end of the day when I'm draining my own personal bank account and then I log into these accounts and, you know, there it is, passive income. I mean, that's the beauty of doing this. But let's talk about my final account here, guys, which is my RBC account. I don't include the performance of this account because there's just not enough capital in it. The performance has been flat, and I'm still trying to bring it to scale. And of course, the only real holdings in this account are RioCan, making up a massive position worth $5,400. And then, of course, Wells Fargo that I'm down 47% on, which sounds terrible. But do keep in mind, that's only a $500 position, so it's barely a drop in the pond of the total portfolio. But luckily, Pepsi, I'm actually up a little bit on Pepsi, only $3, and I'm also up on the dollar exchange rate. I would love to scale Pepsi. It's one of the new ones that's on my radar as I try and scale into different industries and sectors of the market. I'm really liking the consumer staple products like your Pepsis, Coca-Colas, Cloroxes of the world, as I have absolutely no exposure except for Pepsi. So when I'm done with RioCan, that's likely where most of my focus is going to shift going forward, along with looking for some more SPAC related plays. No, I'm just kidding. I'm not really looking for SPAC, but where I am looking is in the MJ markets. I've been having some pretty interesting and deep discussions about the MJ sector in our private chat group, and I think people are underestimating the big turnaround that I'm currently starting to suspect. I don't have the guts to make any major investments yet because I do have exposure to Cron through MO, of course, but I wouldn't mind dipping my toes at some point, probably after the next earnings, into a FRIA. I'm not going to break down the whole MJ sector right now, but I will be making a video tomorrow on it because I think people are... it's been beaten into the ground for too long, guys, and the government has really changed the funnel setup for the Canadian MJ markets. And I've been running some math on the growth rate along with the black market projections and how much market share the government is getting. And it's starting to get a lot more bullish than it has been in the past. So I'm going to keep you guys updated on that. But I'm really happy that, you know, hard work, dedication, you know, constantly grinding ends up really paying off here. And I'm hoping you guys learned something from this video. If you did, in return, I would just appreciate a like, heck, even a dislike, because both of those, you know, generate me better traction on YouTube. It all helps the channel out. And if you have any questions, I'm sorry I haven't been keeping up on the comments as of late. As you can tell, it's been a bit of a hectic nightmare in my life with everything that I've been doing. But nonetheless, folks, stay cool, stay awesome, and I look forward to catching you tomorrow.